we'll move on to other retirement plans. And there are basically 4 types of retirement plans. There's employer-sponsored, and then there's individual plans. And then there's, on the other axis, there's before tax and after tax plans. So basically all retirement plans can be thought of as falling into one of these 4 categories. An employer-sponsored plan would be like a traditional pension, or it could be a 401k, or it could be all of the other alphabets: IRA, SEP, simple, 403b, 457, TSP. There's a bunch of them. But there are employer-sponsored before tax plans, which are typically pensions, and 401k are the most common examples. Employer-sponsored after-tax plans would be like a designated Roth account. And then an individual plan is one that is not going through your employer. You set it up yourself, and you can go to your favorite bank or credit union and say, I want to set up an IRA. You can do that today. Or you can go to any other financial institution like a brokerage. You can set up an IRA. That's the I in IRA stands for individual. It's individual retirement arrangement. And the before tax plan would be a traditional IRA, and the after tax plan is a Roth IRA. And the main difference between these, between the before tax and after tax, is before tax plan, you have not paid any tax on the money that's set aside for your retirement, which means that when you take it out, then it becomes taxable income at that future time. For an after-tax plan, you've already paid tax on your retirement savings. So in the future, when you take it out, you don't pay taxes again. And they're both tax advantaged. They both grow tax-free. It's just that if I put $1,000 into a traditional IRA today, and in 20 years it's worth $10,000, take out the $10,000, I have $10,000 in income. If I put $1,000 into a Roth IRA today, and in 20 years it's worth $10,000, and I take it out, I don't pay any tax on any of the growth or earnings. And the difference between employer-sponsored or individual plan mostly has to do with whether it goes on line 5A, pensions and annuities, which is mostly employer-sponsored plans, or 4A, which is individual retirement plans. Tax-deferred savings, that is, you're not going to pay tax on it now, you're going to pay tax later. That is going to be a before tax plan. Before tax means you did not pay taxes yet, and you will pay taxes later. After tax means you have already paid tax and you won't pay taxes later. There is a possibility that you have paid tax on some of the money in your otherwise before tax plan. We'll talk about what happens with that. And it's usually not great.